Okay, I've been saying for a while that we need to do something about affordability. In fact, we're already starting to see these things in what's called the non-QM space. This is really designed to help affordability. So there's a lot of these creative programs that are coming out. But then there was this bombshell, a proposed 50-year mortgage. Now, there's some problems with this right now because there was this little thing called the Dodd-Frank Act, which was passed after the financial crisis, which basically limits the ability for lenders to give a 30-year, anything over a 30-year under what they call a qualified mortgage. This was kind of their attempt of saying, hey, listen, you need to keep it within these certain guidelines in order to, provide a mortgage that is good for the consumer. And of course, as things evolved, lenders kind of ignored this and created what we call non-QM mortgages, which is basically lenders creating a market that's separate from the agencies, Fannie Mae, Freddie Mac, or Ginnie Mae. I'd be very interested to see if this gets into the VA space or FHA space, but I immediately expect this to hit in the conventional markets. It went ahead and did these comparisons of what a 50-year mortgage would be on just kind of a run-of-the-mill rate right now, around 6.575. A $300,000 mortgage on a 30-year mortgage, that principal interest is $1,529. This would drop to $1,366. Why is the payment lower? Well, of course, we're stretching the term, the payback period, over 50 years, so 20 more years to pay back the loan. Obviously, paying a ton of more interest in that term, but that's kind of the idea, is that you're stretching it out to lower the payment. 30-year mortgages were not even a thing years and years ago. Why did they become a thing? Because of home prices going up and affordability issues. And this is exactly where the market finds itself now, is an affordability crisis. A 50-year mortgage is going to tremendously help with affordability, which is going to flood the market with new home buyers. This is going to put upwards pressure on home prices. Well, it's going to shift a lot of things, obviously. So more buyers in the market puts upward pressure on home prices. More competition, more people qualify, pushes prices higher. Simple supply and demand. However, I see another aspect of this. If you go where the typical, or I'm seeing in like a lot of markets around the country, this $500,000 loan price point, you're looking at almost $300 difference on a monthly basis for your mortgage payment. This is pretty insane. And the article goes down to just talk about how this is going to, again, like I was just mentioning, home price growth. This is going to be really affecting spending. It's going to push the economy. Think about it. If you're saving $300 a month in your mortgage, not everybody is just going to stretch and buy more house. They're going to use those savings. People are going to be refinancing onto these 50-year mortgages to free up that extra $300 a month. Now consider a $1 million mortgage on a 50-year mortgage. Now we're talking $600 a month in savings. That's pretty substantial. But here's the point. Now that this has been unleashed and the market is going to start responding, many are already talking favorably about this. Pulte is already saying, this is great. I love it. Home builders are going to be all for this because they need to move inventory. So they're going to have to fix the Dodd-Frank Act, and they're going to have to allow for this, or allow a provision for these 40 or 50-year mortgages. That's going to take a lot of time. In the meantime, like good capitalists do, what lenders are going to do is they're going to say, hey, there's obviously a demand for this. Therefore, let's go and create a secondary market. Let's get private investors, and we'll put it under our non-QM markets. The 40 years are already existing. The problem is the rates typically, they just don't move with the market. So they're a little bit higher from an interest rate standpoint. Obviously, 40 years is going to be a longer term. 15 years are lower than 30 years, and 30 years are lower than 4 years. That's the way it's typically been. I don't know how this is all going to shake out, because right now we currently do have the ability to have on investment loans, there's a lot more flexibility. You can do interest-only loans. You can do interest-only loans in the non-QM space as well. But here's what's really going to happen. And just to summarize everything, I'd say by spring market next year, 2026, we're going to see 50-year mortgages. We're going to see the 40 years, because of the 50 years, the 40 years is going to be priced a little bit better because, again, it's all about the demand. If there's demand, then I don't want to get complexities with like how the secondary markets work with mortgages. But let's just say this, as the demand increases for this type of product, the end rate to the consumer is going to become a little bit lower. If you are thinking about buying a house, here is the ultimate statement. Buy it now. The second these 50-year mortgages pop, you're going to have an influx of millions of home buyers that are going to now qualify for a house. You're going to see home prices go up. It is imperative that you get into your house now while the market is soft. Super important. If you wait 6 months to a year, it might be a little bit too late. Now, is it going to run up for maybe 1 to 2 years? Yes. Buy now, refinance later. It's very simple. If you have any questions, reach out, leave me a comment, or you can give me a call. My number and everything is in the description. Oh, by the way, if any of this content is helpful to you, or if you like it, please drop me a like and don't forget to subscribe to this channel. This is Rick. I'll see you on the next video.